Work with startups, governments, and investors around energy and security. And at times I also get pulled into other climate endeavors. I think the best thing to do, because my memory isn't as strong as it usually is, going to have the panelists introduce themselves, and then we'll get into some good questions right away.
Hello, I'm Anya. I'm CEO and founder of Kind Designs. I'm originally from Ukraine. I grew up in Israel, and I got the opportunity to come to the US when I was already in high school. And I started as a lawyer. I went to Miami Law, and then realized my city had a major problem with flooding, rising sea levels. And so I left behind being a lawyer, to my parents' horror, and started this company that is 3D printing living seawalls. So they're structurally identical to traditional concrete seawalls you see in New York and Miami, but they also function like marine habitats, they dissipate wave energy, and there's no green premium. The living seawalls are cheaper than conventional toxic seawalls.
Hi, I'm Abijit. I am the Vice President of Gradiant. We are a water company out of Boston, Mass. We've been in operation for 12 plus years, and we are, I guess, relevant for this panel in that we are a unicorn. So I don't know what that means, but yes, we're there. My background has been started off as a chemical engineer, moved on to business and then finance. So I came on to this side of the equation to see how we can make change on the innovation and the tech side for climate tech and clean tech. Yeah, love to talk more in this panel.
Hi everybody, I'm Chris, I'm from Belgium, and we are tackling a 1% global CO2 issue, and that's actually interior walls, so that's black thing. It's 300 billion a year of those walls that we build, and then we throw it away. And it's 1% of global CO2 emissions linked to that, and we just invented a system just like Legos, that we can do it more cost efficient to build the first time, and then at the end of the life, we can simply buy it back and sell it again. And we can do that up to 30 times, which is of course very interesting for shareholders, because yeah, instead of throwing away $300 billion a year, you can just cycle it back in your pocket. So looking forward to the discussion.
Hi, I'm Pooja Khosla, CEO of Intelligent. I am an academician and an entrepreneur both. And I like solving difficult problems, and I believe right now the most difficult problem that we all are solving is that how we can make sustainability profitable, because at the very end we all need return on investments and we all want to build a greener future. And that's where my company comes, Intelligent, so that we can make sustainability impact profitable so more capital flows there.
I would like to know how to make sustainability profitable. Please tell me. Hi everyone, I'm Timur Davis. I'm a partner with Munich Re Ventures. We are a $1.2 billion venture capital firm based in San Francisco. I lead our climate tech as well as our transportation sectors. Within climate, we kind of invest across a very broad range of topics, including climate risk and climate resiliency, sustainability and the environment, as well as the energy transition. One of our notable investors that folks here may be familiar with is a company called 12 in the sustainable aviation fuel space. They just announced a $645 million fundraise last week. It was on the front page of the Wall Street Journal. We invested at the seed round about 4.5 years ago. Oh yeah, so our fund, early stage focus, I would say Series A is the sweet spot, but we also do seed as well as Series B investments. Our check size is in that kind of $5 to $15 million range. And me personally, I've been with MRV for the last 5 years and in the venture capital world for about a decade. Before that, I was a consultant, and before that, I did a PhD, just a little bit 110 blocks north of here.
Okay, so for any of you founders in the room, I think that oftentimes when you see founders on stage, it seems very glorious. And even for investors in the room, it might seem glorious as well, but we know that the reality is very different. So I wanted to just jump right in, and this is a question for the entire panel, which is, what are some of the misconceptions that you, either as a founder or on the investor side, see, and really think about it as far as within the climate space, what are the barriers and challenges and the reality of actually being an investor or a founder in the space?
Whoever wants to.
Well, I'll start, I guess. Well, interestingly enough, in my introduction, I didn't mention this, but I did spend about three years doing investment banking for early stage climate tech startups. And one of the fundamental things, and when I say climate tech, we're just talking about companies that are contributing to the space of sustainability, the space of climate. One of the main challenges, I think, it's more from the investor standpoint, is a lot of climate tech innovation needs substantial amount of brick, mortar, cement on the ground. It's all the hardware, there are components to it, and unfortunately, there's a big part of the investing world that is still trying to gravitate towards understanding how do we use these assets on the ground and invest in these companies, because they don't scale at the same rate. But I think the misconception part of it is also that these hardwares or stuff that you're putting on the ground are necessary to be able to make any credible change in the climate space. And I think there's a misconception that by its true nature, due to the hardware part, investors can't get a valuable return as compared to something else. So I think it's also about the wrong benchmarks that are there in the sector. So yeah, that's possibly one misconception that, or one concern I would say that prevents the access of capital to clean tech. I'm sure there are a lot more.
Yeah, I can agree with that. So hardware is hard in funding, and it's linked a bit to what you're both saying. It's linked to, I don't think we value for instance, we're in circularity. It's actually about how to value, what is the value of circularity? How much value, shareholders' value can that create? And if once you start measuring it and expressing it in real numbers, and imagine what happens if you're scaling those technology up and then see what's the actual hardware value, then you will see that with climate tech there are huge potential upsides with it, but it will just take a bit longer than a AI startup that's launching ChatGPT, for instance. That goes a bit faster than us. But if the funds are there that will have a long-term vision, the value creation is immense on the long term. So I think that mind shift, that's a difficult one for us as hardware founders.
And just to add one challenge, I think we see a lot of money being earmarked for climate. There's a lot of very fancy bills being passed, but that money is usually going to government and nonprofits. It's not going to startups who are taking big swings and are doing the work to be able to have a chance to have real big impact. And I think there has to be a reevaluation of where that money goes, and a realization that startups can be a massive force for good. Because startups, nonprofits are not designed to take in $1 million, for example, and turn it into 10 million or 100 million in value. That's exactly what startups are designed to do, and build massive teams and scale to every single city. So it'll be great to see more funding from government come to startups so they can see a massive return on investment and benefit to society.
So for me, I see threefold challenges, and I call it 3E for climate startups. The first is education. This climate tech is a new word coined. Everybody is learning together. And it's not only for us, the startups, who wants to explain what we are doing, how are we making profits, and how are we going to multiply investments of investors by 10x, 20x. It's also at the VC side, like you are learning about so many new businesses so quickly. And so the first is education. Second is evaluation. Like I speak to venture capitalists and they really make me think, like, how are they going to evaluate not only the profits, the scale, but also impact we will create? And the measurement standards about how are we going to make an impact are still very theoretical. They're not practical. And I think this matching of evaluation, even being a startup, I am learning, and I'm pretty sure the VCs who have mandates to invest in climate tech, they are learning every day. And the third is endurance, because there are no other business like us. We are unique in our own way. So we don't have benchmarks to compare. So we are our own benchmark. So we have to have much endurance to stand out as a business of one of a kind. And it's difficult to be one of a kind business.
Yeah, it's funny because I think people assume, oh, VC is so easy, you show up to panels like this and, talk about random bullshit and then go have a nice dinner and go home. And that's absolutely part of it. But it's really challenging to play in the climate space. And I'll give a hand, there's many reasons, but I'll give a couple or a few. First, and I think it's been hinted at earlier by others on the panel, the timeline toward exit is very long, or longer, for climate companies, particularly those that are building things, so not pure software, but hardware or hardware plus software companies. It just takes longer to physically build things, put them in the market, get sufficient traction with customers, etc. Right? And VC is designed to operate on a very specific timeline. You raise a 10-year fund, you invest for 5 years, you have 5 years to kind of collect the return while you raise the next fund. And if things don't fit into this very neat timeline, then it's actually difficult to operate. So that's one. Two, climate companies tend to be a lot more expensive. Again, because you're building things, right? And so what that means in practice is the startup has to raise more money. And so there are, there's many graveyards worth of startups out there that have brilliant ideas and great technology and smart people that just for one reason or another, they couldn't raise the money that they needed, right? I mean, I just mentioned 12, right? The plant that they're building right now, it costs $100 million, right? That is a lot of money. So, it's, as an investor, I can put 5 million, 10 million, 15 million, but that's not enough for a lot of these folks that are building things, right? So that's the second challenge. And the third is that the exit sort of pipeline, right? So how do we make money? We need our company to either go public or for someone to buy it. Well, the exit pipeline is not a well-trodden path in the climate space, right? How many successful meaning, $1 billion plus acquisitions in climate can people think of? 1, maybe 2, maybe 3 if you're lucky. That's not a lot, right? If you look at any other space, SaaS, right? In AI, right? There's a really robust history pipeline, things you can point to and say, oh yeah, this company had a successful IPO, this is the path they followed, we're going to do something similar and we're going to have hopefully similar outcome. You don't get that in climate. So it's a very difficult industry to invest in, I would say.
You can hold on to the mic because I actually want to double click on something that you said, and I was going to ask it later, but it's more appropriate now, which is, so the VC model you alluded to, one point has to do with the horizon times. But if we can zoom out and share, what are certain applications of the VC model that work and what doesn't work? do we throw everything out that we know as far as VCs and climate? Are there things to keep? And maybe if we can, if you could just answer that, and then I would love to hear from the founders afterwards, but if you could grab that next after Timur, that would be great.
You're putting me on the spot. No, I think we've seen venture firms try to, innovate on this topic, right? So for example, some of the, deep tech, sort of climate tech firms have longer timelines, right? So rather than 10 years, maybe 15 years, 20 years, because they know it's going to take longer for some of these technologies to reach fruition, right? And have sufficient traction in the market, right? The problem with that is, as an investor, you are under pressure to return money to your investors. And in some cases, they're okay with longer timelines and so on. In other cases, they're not, right? So if, your investor is Bill Gates and he doesn't really care, right? He wants impact in terms of gigawatts of, or gigatons of carbon captured or whatever. He's not really looking for another $1 billion of return. Okay, fine, that's possible. But in our case, our investors are institutional, financial institutions. I just said institution twice. Anyway, financial institutions. They need money tomorrow, right? And so that longer timeline is possible, but it's not always, applicable, right? Another way folks have tried to innovate is they've said, okay, well, in addition to financial return, we also want to measure, impact, right? And impact may mean jobs created, it may mean gigatons of carbon captured, it may mean, emissions abated, whatever, right? Okay, great, but that doesn't really convert to dollars. And so those funds, again, if they have the right LPs, it's cool, but if their LPs need return and their LPs are investors of funds, sorry. If their LPs are allocating their assets based on return expectation, then this strategy also doesn't really work well. And so I think it's really difficult to kind of find that balance that allows venture firms to adapt a little bit to the reality of climate, but still be able to consider themselves venture firms rather than philanthropies or catalytic investors or whatever. And this is, I think, an ongoing process. No one's really figured it out. I think folks are still learning today. So I think, in summary, evolution needs to happen, but I don't think we've really figured out how to do it.
Yeah. Well, I think, to Timur's point, the whole need for patient capital for climate tech and clean tech, I think, has been spoken about. It's for the last 10 years, we know we've had Clean Tech Cycle 1, Clean Tech Cycle 2, and Clean Tech Cycle 3, and VCs have still trying to get a hand of it. But on the evolution piece, that you spoke about, maybe a couple of things that I have experienced, either raising capital for startups or even in my own experience with Gradiant, is that I think fundamentally there are certain structures that the VC model had built over the years that don't percolate into the clean tech space. For example, I think one of the things in typical venture capital investment is it does still have the winner takes all mindset. Like, you need to back the startup has to grow 10x, 20x, 30x, and it's probabilistic. That means 1 out of my 10 startups will possibly succeed. There are some of these thought processes that went into VC models as to why the return expectations are so high, etc. I would say that in the clean tech space, it's not winner takes all. It is, the place is pretty, if you've got an innovation, the market is big enough for multiple startups of a similar nature to coexist and thrive. So that is, one thing that I think that investors investing in clean tech need to understand, that there are multiple ways to solve the same problem. Like, if you've got efficiency issues there, you can invest in either a good HVAC innovation, or you can go into good building materials, etc. That's one. The second thing, to your point about return to LPs and to fund investors, is my personal view is I think there is a disconnection. There are like three different expectations of returns for the same startup. There's an expectation from the LP side, then the GP side, and then the founders have a different view of expectations. So there is a slight case of misaligned expectations. I think that the whole also the discussion of whether 2 and 20 is the right structure for VCs, or whether we should look at LPs and GPs acting as co-investors into a startup. So that's the other thing. And third thing, to my earlier point, and I think we discussed a little bit about the need for putting assets on the ground, is the compatibility of early stage venture capital to work with later stage debt, later stage banks, all of them who are huge sources of capital. And how do you be okay to partner up with, let's say, a hydrogen startup that has scaled, has got good customers, has got good contracts? How do you help those startups go to banks and other institutional capital that is available in the sector, which is, something that needs to be explored? So, these are a couple of points that I thought.
Absolutely. I would add just to Abijit that I love clients' cash, whether it's from sales or whether it's from capital. And we do have opportunities to partner where we can make core revenues or launch core products with big banks and then invite their LPs, GPs to invest. And I strongly recommend that to the founders, that clients' cash is beautiful.
Maybe just Chris and Anya to answer to, on your side, fundraising, how has it been in the interaction with the VCs?
So from my side, I actually like the fundraising and the time pressure part of it, because the ambition of the company is to create impact. And impact is how much CO2 or whatever are you saving per unit, times how much units do you sell. So I like the concept of a VC breathing in my neck, just to push my teams and push our company to create as much as impact as possible. And the financial part of that, and also the return of it, is the logical consequence of it, but it's mixing well together. So I see a lot of founders not going for the VC route, but they're not creating an impact, they're not big enough. So I rather dream big and think about, okay, how do we get to the billion points than that. So in my point of view, it's good that they're so time pressured, because the issue of climate is also very time sensitive.
I love VCs. I love my investors. I have a very special relationship. My first investor is here, Ankh Impact Ventures, my first check ever. And I think that relationship, well, first of all, we were lucky to be oversubscribed in our seed round, because I wasn't stuck being, we're a climate tech, we're only going after climate tech VCs. We're also a construction tech company. So actually strategically, most of our investors are construction companies, which helps with sales, and lots of government people. Like half my cap table is ex-government people, which give us a lot of lobbying support at cost basically. And every single month, religiously, I send them investor updates. Like there can literally be a hurricane in Miami. I am writing my updates, sharing ups, downs, and always asking for help. So it's a very hands-on relationship that we have. And so I think embracing the VCs has worked really, really well for us for this round, and already for the next round. There are so many VCs that we know and we've kept in touch through updates, so that fundraising will be successful again, I believe.
Just to add, for the folks in the audience that are thinking about what to do, maybe. So the big challenge, and Abijit kind of highlighted this, so I want to go into a little more detail. One of the big challenges that we're experiencing right now in climate tech is this transition from venture backing to institutional, bank or whatever backing, and de-risking that scaling, because that middle space right now is, what we're calling the valley of death. Because, if you want to build a plant or, a pilot facility, it may cost you, 10, 50, $100 million. And using venture money to pay for it is impractical at best and impossible at worst, right? It's a lot of money to raise, it's a lot of dilution to your capital or to your cap table. And so folks are trying to think about, okay, well, how do we fill that middle? And there are some venture firms that are experimenting with, for example, doing both equity investments into the company and investments into the project, right? Like, for example, Spring Lane Capital, folks may know, or TPG, or Breakthrough, Generate, etc. But that is a very complicated model because the returns expectations are different and the type of due diligence that those two sides do are different. And it's a very different mentality, it's a very different set of people. And getting them together in the room to agree has, rarely been successful. But that is the biggest challenge in the space right now. And so if anyone has any ways to solve it, then I think we would all like to know. But I just really want to highlight that as an important topic, both on the startup and the venture side where innovation is needed. Thank you.
And also, if I could just add, as someone who works very closely with investors and the entrepreneurs, when entrepreneurs are starting out and founders are starting out, many of them are just trying to get by with their seed, maybe with their mindset around an A, definitely not thinking about the different set of metrics or the way that the model is going to work for growth. And in my opinion, the smart investors are the ones who are going to communicate to the founders and ask those questions to help them think about those later stages. I'd love to ask the three founders a question which has to do with access. So we're talking about immigrants, which doesn't mean that you don't live here, but even if you don't live here and you're thinking about scaling to the US, access to subject matter experts, early stage design partners, investors, it's so critical. How did you go about and how do you go about thinking about gaining access, whether it's through your investors or in another way?
I would say that the best thing of access is building trust and relationships with your investors. I'm a co-founder, and working with the right co-founders also. Like in my case, I got blessed to found a co-founder who was ready to fund the company. He's sitting here right now, Tom Stoner. And also a product co-founder who is a Nobel laureate himself. And when the idea comes together on the table, I think that access was very important for us to where we are. And then finding right partners in format of investors. And one of our investors was the bank that we had the most successful product with. And they were baby steps, but they made us who we are, and they will help us grow. And in my story, it's not only access to capital, it is also access to live in the country, like you saw the presentation before we came. So I came here as a student on a student visa. And I still remember when my co-founder and I were raising capital together at an early stage, seed capital, investors has concerns about my visa status. So we have to go on a route of visas which are in special categories that are devoted to people who can create businesses or knowledge or scientific ideas that are breakthrough. And US governments welcome it. But access to that network who can help you to get that visa because you need multiple industry sponsors was also a different kind of a fight. So it's not just access to network client, but also to the right people who can solve your immigration issues.
From my side, I come from Europe. I think, getting the contacts and getting the networks, it's from in my interpretation much easier here in the US than in Europe. So my biggest advice actually to anybody from Europe, I'm always telling this in Europe, is don't waste your time there. It's just, it's a horrible market where the VC landscape doesn't work. Yeah, yeah, but it's this, in my opinion, again, I'm from Belgium, but you just showcase the value here. It's just to the point, showcase the value to the clients, showcase it to investors, and you can move forward. Simple, to the point. Which with us, they just make it more complex, and they only want to see the risks of something. So Europeans, they want to see the risks, and they don't want to see the opportunities. We're talking about $1 billion company here. That's the idea alone is just crazy in Europe. So if you're from Europe, and sorry for ClimateTech that's here, but just come here. That's my advice.
Yeah, we're so lucky. We're literally in the greatest place on earth to build something. It would be insane to pass up that opportunity. And I think one of the things we have in common as immigrants is being extremely scrappy and creative. There's always a way. And so, for example, for me, when I was starting out, I couldn't afford a physical space, a warehouse, because every landlord wanted proof of funds to give us a lease for 5 years. But to get funds, I needed a proof of concept. I needed to have a place to bring my robots to print a seawall. So I was stuck in the situation. So I came up with the idea of convincing one of my customers, so a big seawall construction company, installer in Miami, to invest. He didn't have cash, but he had an extra warehouse. So he invested $400,000 in kind, which gave us rent for 2 years for free. So that was awesome. And I got to say that the biggest customer in South Florida is on my cap table. So that actually really helped bring in all the other investors, because that guaranteed us sales for the next 5 years.
Timur, what today with redundancy, I guess, or if you are seeing redundancy, what makes an investment stand out? And then on the founder side, I'd flip that around and ask you, when you're looking at competition, are you seeing increased competition in your space, which I guess for the investor side would be, or I would call it redundancy. So what makes investments stand out today?
By redundancy, I think you mean kind of the 10th company doing the same thing.
Yes.
Yeah, so this is I think an interesting point, because when I started to invest in climate, there was very little. so you know, everyone was the first company, right? It was the first hydrogen, green hydrogen company, the first SAF company, the first, whatever. And now it's crazy, right? SAF companies are popping up like weeds, and they're all telling kind of the same story, which I think is challenging, right? Because if you're a founder, you should put yourself in the mindset of investors, right? Investors take a portfolio approach. So, in our portfolio, we have a SAF company, we have a geothermal company, we have a water company, we have et cetera, right? And we're probably not going to do 2 SAF deals. SAF, sustainable aviation fuel. I realize I should have defined that. We're probably not going to do another sustainable aviation fuels deal, because we've got one and it's doing fine. And so when you as a founder are thinking about, okay, what am I going to do? If there are topics that have already had well-funded companies far along on the kind of the arc of their journey, then you better have a highly differentiated product, technology, team, customer, something that's going to separate you away from the pack very early. Because what I think you have to recognize is that a lot of the folks that you'll be approaching as investors, well, they've already made a bet in the space, right? And the pool of potential investors who haven't may be a whole lot smaller than you may initially think, right? When you look at the landscape and say, oh, there's a ton of different climate investors I can go to. So now, obviously I'm not saying like, hey, don't do it because someone else has done it, because innovation happens in every area, including in the most saturated of topics. But I am saying that you have to be really thoughtful in terms of your value proposition, right? Like, our team is world class, right? We have IP that's highly differentiated. We have a customer that's willing to buy something that will, that will present you in a unique way compared to, everything else.
We're in a unique position because we're the first company in the world to 3D print seawalls, and for now the only company in the world to do that. There's other startups maybe making little tiles, which are beautiful, that you can attach to an existing seawall to make it more green, but there's no one else in the world 3D printing these structural walls, which of course has its benefits, also has its challenges, because we're in the front lines, we're taking the arrows. For example, we've made tons and tons of progress on the legislative side, so working with local commissioners in the state to create incentives for homeowners to choose living seawalls over traditional walls, which is great for us, but that opens up space for then others just come in and already, it's a very nice, comfortable place for them. So the key is to stay ahead through constant innovation. Right now we have the world's fastest concrete 3D printer. We're constantly innovating the operations, the printing, and second, to capture the market. So Miami is the biggest seawall market in the world, so we're getting the key customers, getting all the governments on our side, and then developing our brand. So we have that momentum when eventually and inevitably competition enters.
Pooja, I wanted to ask you about regulation. A lot of the times in nascent spaces, it's the job of the startup and the founder to educate regulators in order to help design, inform. In your experience, what has that role been like for you? And this is, feel free anyone else to answer about the way in which regulation in your work is coming to play.
Absolutely. This is a very interesting question because we are in a space of climate scenario analysis and climate stress testing. And my friends who are coming from Europe, they know that how regulations in Europe, especially like CSRD regulations, are compelling not even big-sized companies, but even private companies to report on their climate footprint and do the checkbox exercises. And some countries are in advance, but in some countries, and especially where I operate, the regulations are still into construction phase. And there, your job is not only to create a market which will use your services, or which will use your services to de-risk investments and make resilient portfolios, but your job is also to actively engage with the regulators in the space you operate, that why the companies in our country need laws that are very similar to what Europe have adopted, what Australia has adopted, Hong Kong, mainland China, New Zealand. And for me, it's kind of a journey where I really engage with White House, roundtables, publish, have a voice in order to make sure that I'm not only heard from my clients, but also from the side of the regulators, because we really need resilient companies moving forward. And once the regulators adapt and copy the modules that other developed countries and developing countries are adopting, I think we will all be in the direction of a climate success story.
Maybe, yeah. So indeed, in Europe we have more regulations. Important is that there are smart regulations, so they're not always as smart. So if you want to regulate, make smart regulations. But as a climate founder, educating the people is important. So for instance, next to JUUNOO, I also created the Circular Value Institute, which is actually an institute, a non-for-profit, that educates people how to measure the value of circularity so that you can put a number on it, and then you can start analyzing what can we do with the business models. And then with that, then you can start other kind of ventures, like we're also starting up the first materials as a service company in the world that actually pre-finances circular valuable products, like for leasing and stuff like that. And that's all within that sphere of regulations and education of governments, because once in a government law or in a public tender, they are going to add the value of circularity as a component, not only the price on day one, but how valuable is this at the end of a life. That has a huge effect on our company, but also on millions of other companies which are in the sustainable field. So educating them is very important so that they don't make stupid laws, and then they make laws that actually bring us closer to the point of creating impact in the world and making a change.
So yeah, to both Kristen and Pooja's point, I've had the experience of actually working in currently water, and then previously in alcoholic beverage innovation, and then previously in the solar and in the power sector. So regulation is, I see regulation actually as a market driver. I don't see it as, I see that as an entrepreneur, as a founder, you need to know which country is has actually having a regulation that supports your business, and just go double down on that place. And regulation per se, and that's, I would say, one of the advantages and the bane of climate tech, that you need to keep, it's not only your customers who's going to dictate your market, it is the regulators who's going to dictate your market. If there is certain areas that have a certain problem, that, like for example, when we were doing this, the innovation in alcoholic beverage, we found that there's regulation globally on how much you can, and it was basically an innovation where we could concentrate the beer, so you don't have to transport the water. So it was all membrane tech that allowed us to concentrate the beer. Now, in certain countries, I'm not allowed to concentrate beer beyond a certain percentage. So there was no point going and preaching to the wrong audience. So it's important to have a good lens on what the regulators are thinking.
Yeah. So one interesting sort of observation, when I started investing, government was like a bad word, right? We always told startups, you should be looking at commercial opportunities. We don't want, subsidies or, regulation to be a driver of your business model, et cetera, et cetera, et cetera. And that has changed so dramatically in the last few years. Right now, defense tech is one of the hottest segments in the startup venture ecosystem, and us too. I probably spend more time talking to Department of Defense than anyone else, right? We look at all sorts of fun defense technologies now, I'm not sure exactly why this shift has happened, but I think to a large extent it's because as funding has dried up in other areas, at least in the US and also in Europe, the government has stepped in as a kind of tremendous source of funding, particularly in climate, energy, and obviously defense. And so I think it's a pendulum, right? It swings, but for folks that are founders or thinking about being founders, I would say don't be afraid of government, right? Not like it was 6, 7, 8 years ago when you have to do everything commercial and don't you dare imagine a government customer or a government source of funding or whatever. Right now they play a really, really important role, and moreover I think the government is getting a lot smarter in the US. Europe I know is a different ballgame, but in the US the government's getting a lot smarter in terms of funding innovation, right? And if you look at what's happening with the Department of Energy, with the Loan Program Office, with the Office of Clean Energy Demonstration, and there's an infinite number of offices, they're deploying billions and billions of dollars into innovative climate technologies. So I would very much encourage people to kind of keep their eyes open to that topic.
I think one of the better things to realize is that governments also compete. And so if you pay attention to what's happening today in the US and why the US is taking more risk and deploying more capital, and then you look at how the US views its geopolitical competitors, then you'll see a good trend to follow. What are some of the programs as founders that you think about taking part in, any accelerators or government programs that you think might advance your goals? And as investors, do you, when you're looking at diligencing some of the startups, if they've participated in, I don't know, Y Combinator or any program, does it categorize them as more investable or less investable?
So in my journey, we do have taken help with the government programs like audit and SBTR grants, and these grants may not come in a format of money always, but they can also come in a format of education, building right teams, and training you regarding your go-to-market strategy, evaluating your ideas, because some ideas are good, but some ideas are the best. And what's the difference between good and best? What can make you unique, make you ready for investors like Timur sitting here? So we have taken a lot of help from those grants, and we were matched with good academicians, good entrepreneurs to learn, good technical teams to bring up the product. And beyond government also, there are big companies like accelerator programs. My company, Intelligent, was into Google Accelerator. I still remember the first employee laptops were sponsored by Qualcomm accelerators. So it's been a long journey from where we started using, government money, accelerators. We were in SocGen Accelerator, and now SocGen owns 5% of the company. So I think once you have an idea, don't think about, just the money. There are other services which are available, and like my friend Anya mentioned, I take help in any format when it's offered, because I know I need help.
Yeah, from our side, we participated, for instance, also in the ClimateTech accelerator. That was the best. So I did many, so shout out to them. If you're in Europe, but that was the best. And they learned us how the real VC world works, the American VC. So that was very nice to learn that there. And okay, yeah, in Europe you have a lot of government grants. It helps. If you have a grant, we just received one of $1 million euros. That's nice, but also the bad part then, and this would be nice if European governments could solve this, 20% of that goes to admin work. So that's a horrible waste of money that you lose, $200,000 or euros on admin work, on spreadsheets, and then you just, now you can ask ChatGPT to fill it in and you send it over, but it's sad. So it would be nicer if it would be just more to the point, do stuff with our money, because they have enough money. They just need to, give it and just measure what are you doing with it. Because founders, a good founder takes money and makes from that money a 10x, a 20x. That's the difference between a good founder and a bad founder. Just give them money and see what happens. Like for Europe, I'm talking, here it's another field. Yeah.
Anyone else? Yeah.
I have very strong opinions on accelerators. So for the founders, or people who are thinking to be founders, it's really important to understand that not all accelerators are created equal. And there's a tremendous gulf between the good ones and everyone else. And don't fall into the trap of joining some BS accelerator, particularly if they're asking for equity of yours, without knowing exactly what you're getting out of it, or at least having examples, demonstrations of what you can get out of it. So ClimateTech is good. We know you guys. We've looked at your companies. But the best ones, at least in the US, the ones that I think, really strongly support are, for example, it used to be called Cyclotron Road, and now it's called Activate. They started in Berkeley and Stanford, and now I think they're also in MIT and maybe Harvard. They don't take equity. They have very few winners or fellows in the program, but they give them money and they give them lab space and they let them experiment and try things out and they help and et cetera, et cetera. That's an excellent accelerator. I think we have 3 or 4 companies in the portfolio who came from Cyclotron Road because we respect and we trust that that team did a really thorough job in their due diligence early on when they took the companies in. Another great example, in Canada, the Creative Destruction Lab, if anyone's familiar with them, they don't take equity, they actually give a lot to the companies that go through the program. YC, they take, but they also have a tremendous profile. Although, I think, how do I say this politically? I think the expectation of companies coming out of YC does not always match the reality, but they have at least a track record, right? But if it's just some guy in his basement who's giving you a small office space and taking 10% of your company, don't jump on the first opportunity that comes by, please.
I would just add to what Timur said that I would strongly agree, because throughout our journey, the accelerator programs were givers. None of them took equity from us, but they give us technology, tech stacks, cloud space, laptops, and they gave us an opportunity to experiment more and become brave.
Thank you. I'm going to open it up to the audience, right?
This one's for Timur. You talk about government and dual purpose. I think you were inferring dual purpose. How are organizations like In-Q-Tel, because they're also in the Bay Area where you are, how are they on this journey with you now? Are they looking at, are you collaborating with them? Because you're more of a commercial VC, they're kind of like a government VC, but they're also a broker. As Pooja mentioned, it's great to have a Sherpa that can say, here's your design partner or use case, and then we can give you, non-dilutive equity through a grant. So just would love your thoughts on that, because you did bring it up.
On In-Q-Tel in particular, or?
It seems like In-Q-Tel, from my experience, is doing a lot more, and they're both you're in the Bay Area, and they're in the Bay Area, and
Yeah.
there's a lot.
So we have a very strong relationship with In-Q-Tel. In-Q-Tel, for those who don't know, it's the VC arm of the CIA, basically. But they are kind of the external-facing organization within kind of the broader Department of Defense. And the way that they function is that they'll make a generally pretty small investment into a company, but then they'll help them kind of connect with the right departments in DoD for future collaboration. So that could be CIA, it could also be Homeland Security, it could be various branches of the military and so on. I think In-Q-Tel is great. Now, they take a kind of spray and pray approach. I think In-Q-Tel has more than 300 portfolio companies, maybe significantly more than 300 at this point. So they're not really in the business of being, I would say, particularly financially motivated investors. They're not looking to make money. They're really kind of looking to get a toehold into a company that would then lead to kind of other relationships with various DoD agencies going forward. But we've always viewed them as great partners, and we know the team there really well. I think if In-Q-Tel invests, then it may be challenging to work with certain to do business in certain countries. So you have to be careful about that. But I think it's definitely a good deal in that sense. The one weird thing is they have some very weird financing structures. So devil's always in the details with them. But a great partner, and I think a great effort from the government to take a more active role in the venture ecosystem. Does that answer your question?
It does.
Yeah. I think we have 2 or maybe even 3 companies where In-Q-Tel is co-invested with us.
And they historically haven't been skewed towards energy, but it seems like they're doing more of that now. Is that what you're seeing as well?
So is to an extent, I would say space is the industry where we have the biggest overlap with In-Q-Tel today, which makes sense. But yeah, they're definitely expanding into cybersecurity, into energy, particularly when it comes to the security of energy. Yeah.
Hi, Neil Walmsley from ClimateTech. So thank you for the kind words about the Climate Accelerator. And I should actually say our best program has been the one that Munich Re has supported for the last decade in Switzerland, Austria and Germany. So thank you very much for that. Totally agree on the comments on Europe in general though. And that's part of the reason we were created, was to try and look at some of these which we're still working on. The slightly bigger picture problems than we're quite capable of fixing ourselves, but we are trying. One thing I would say though in Europe that we have observed is that in recent years the European Union and the individual governments are trying to be a little bit more of what you might call market makers for innovation, in the sense of whilst they're not necessarily great at directly supporting innovators, some of the strategies they're putting in around the European Green Deal, the Sustainable Cities programs and so forth, which are quite big investments for Europe, are intended to make it easier for innovators, solution providers to have their products and services adopted by public agencies, whether it's like smart city systems, decarbonisation of industry and so forth. So just to say, the market will hopefully be more supportive of at least established enterprises developing these innovation solutions. Thank you.
Thanks to everyone. My name is Marie. First of all, Anya, congratulations on something that's so creative. I really love that. We're actually working with Miss Dr. Pooja Khosla in Intelligent, but I bring a perspective in that I was part of the executive leadership team for both O-Power and Tendril. O-Power got to ring the bell up the street, so that was exciting. Part of the difficult part, and I'm going to push this on Timur a little bit, the difficulty in this category is the barrier to entry, right? It's not just that the technology is either hardware dependent and therefore hard to entrench. It's that you're changing hundreds of years of thinking and process, and you're moving a very cumbersome thing forward. The reality, though, is that investors who stay the course see, exponential return on their investment. Not a lot of them have that staying power in the very beginning, but I can tell you the investors in Tendril, Tendril is now Uplight in $1 billion valuation. O-Power was eventually acquired by Oracle. So the investors there are very happy now, but they weren't very happy early on. So how do founders who are facing that today deal with you guys on the front end of this? And this is for Timur.
Oh, I thought it was a question for founders. Sorry, so it's how do
you guys evaluate that? I mean, how do you have the staying power? The founders themselves have the staying power. I think it's the investors that struggle to kind of wait. They want the return more quickly.
I mean, investment's kind of a marriage, right? Once you invest, you're kind of stuck, right? Whether you want out or you don't, you're kind of stuck. I guess unless you find someone to buy your shares, but that happens rarely. So I guess the question, can you maybe repeat the question?
I find that investors early stage are looking for returns in a time frame that's untenable for this category, for anything in climate, anything in energy, anything that's transforming a category that's been entrenched for as long as it's been entrenched. So how do you go about evaluating that? And what kind of conversations do you have at the table that say, hey, we're willing to, kind of be in this for the long haul and not put the pressure on founders to do that flip?
Yeah, so I kind of discussed this at the very beginning. Like the classic venture model doesn't always match well with the reality in climate tech because, as you said, it takes a while to build things, to get, product market fit, to get customers, et cetera, much longer than if you were a software SaaS company, delivering pet food or whatever. I think what we are seeing, I kind of mentioned this earlier, we're seeing a little bit of innovation in terms of folks with longer timelines and so on, but that's not always the case. What I think we are seeing, though, is investors like ourselves that do play in this space kind of have our eyes open. We're not anticipating returns in 3 years for a seed company that's innovating on, power transmission, right? We realize that's going to take a decade, maybe decades, and we're approaching it with open eyes. I think what we are seeing now, though, that is new, is that there are investors in climate tech that play at different stages, which wasn't really the case before, right? There are growth investors in climate tech that didn't exist even 5 years ago. And so for the startups, I think there are now pools of capital that kind of can take you across different stages that until you can, get bank loans and kind of more traditional financing, that even a few years ago didn't exist. Now, does that alleviate the push toward making a profit for those early investors? Not so much, to be clear, but I think, as long as you're growing and as long as you're continuing to be well capitalized, it's not a bad situation. As an aside, we also see some secondary markets for shares becoming a lot more prevalent. So investors selling their shares to new investors. But it's not a liquid market, and it's challenging for many reasons to play that game.
Add to that, you've got experience with O-Power and some of these successful companies that have actually managed to...
Speak a little closer to the mic.
Oh, sorry. Actually managed to attract public capital. At Gradient, we started off in 2012 out of the labs of MIT, and we just closed last year around a $1 billion valuation, and we are category changing in the water sector. And water, as you know, is one of the most old school sectors ever known to man, right? And I think fundamentally, the answer to that is getting the right investors early on. And the biggest advantage of climate tech is that you don't necessarily need, but you don't necessarily need venture capital. You have various other forms. And when I say venture capital, I would still call it Munich because it's more like a corporate venture house, which works like a VC, but there's a lot more capital out there from family offices, from private equity funds. So we've got 2 private equity funds that backed us over our journey. You've got customers. So you'll be so surprised how many customers, when you go convince them that your technology works, they want to be like, wait, if I'm buying your tech, I want to have some skin in the game for your upside. And I've seen customers become a huge potential investors who are a little bit more patient because they're already in red ocean markets, so they understand the time. And yes, as Lotan said, there's also different business models that you can build. We were talking earlier, Chris, about ARRs, which is like a standard parameter in the VC space. How do you create things like clean tech as a service, like hardware as a service, like water as a service, energy as a service, efficiency as a service, and start creating ARR type business models that allow potential exits and or give those early stage investors the valuation leverage that they seek.
Hi, thank you. I'm Jessica Stromback, Jewel Assets. So one of the comments that you made, Tim, was that I was interested in is just this gap, and you've all been circling this question several times, but the gap between that initial investment that's really investing in the idea and then the infrastructure that's needed, the infrastructure investment that's needed afterwards. And you mentioned Generate, and there's a couple of other players, we also, Anya mentioned actually having one of her clients invest. That's another way to do it. When you're talking about the cultural separation of one set of investors that's looking for an asset-backed debt investment or equity investment versus yourselves, can you speak a little bit around how that gap might be bridged, say, by forming partnerships or, making it more formal process, or just thoughts you have around that?
Sorry, just to make sure I understand. You mean kind of bridging the gap between the early stage investors and the later stage investors, right?
And one that's
Yeah. So I think the reality is that, in my opinion, investors at every stage have quite different ways to underwrite. And I kind of recently experienced this myself. I generally tend to be an early stage investor. And the way we underwrite is, hey, is this cool? Yes, okay, give them some money, right? Like, we don't care about financials because there are no financials, right? We look at, is the team competent? Can they sell? Is this like a big TAM? Is it a big market? And is the technology differentiated? Is there IP, right? Recently we did a deal, actually in the water space, one of your friends, Whitaker, which is a later stage, venture-backed, but later stage company. And we got to see the due diligence that the later stage investors do that were in the round with us. And it was all about financials, right? They were building models and looking at all this crap, and I had no idea what they were doing, but it looked good. Very good Excel, right? Very good analysts working at 2 a.m. And so they were underwriting to a completely different set of standards than we were. And then if you take that one step further, if you think of the fund that's now looking at, okay, a project, right, and what are the returns of this particular factory that's making X, Y, and Z, I imagine that's even more technical, right? And so getting these folks to speak the same language is actually very challenging. Some are, so I mentioned Spring Lane, for example. TPG is a partner of ours, that's another one, where they can do both equity and debt, and they can kind of figure out some really unique structures. But those are few and far in between. And generally, what you really want is a very graceful handoff from one set of like ideologies to the next. So what we say to our companies, right, when our Series A go to the Series B, or our Series B go to the Series C is, like, if you plan to raise that Series C in 2 years or 1.5 years or whatever, you have to today kind of put yourself into the position, the mindset of what those investors are going to need, right? And so if that means you need to be rigorous around your financials, then you have to get into that practice now, not in 2 years when they're asking you, and you have no idea what they need. So I don't know if that exactly answers your question, but I think it's really hard to change your mindset. Like, I know I would be a terrible private equity investor, but I also know that they're terrible venture investors because I've seen them in action.
Well, just add, so I think one of the interesting thing is at early stage, as to Timur's point, there is a story that is the lead, right? You lead with the story, and venture capitalists back your story, or listed investors back your story. At some point in time, there are investors, and largely the later stage, who are basically evaluating how much has reality matched the story you've been telling for the last 5-6 years. And so that transformation between story to reality involves systems, processes, procedures, people, having the financials in place, having a proper supply chain in place, having the right customers in place. And so you actually go through a totally different diligence process. And sometimes it's like, that's where I think there is that, it's actually a very different skill set, right? I mean, the skill set that manages to be able to talk to those investors are slightly different than the same skill set that you required or you used to get your early stage investors. So it's kind of that, navigating, I think, what's called there's so many valleys here, the scaling challenges and kind of.
Timur, I know I'm a panelist, but I have a question for you. Yeah. We spoke about early stage access accelerator. We spoke about later stage. And I know that Abijit is in that group, but Chris, Anya, and I are somewhat in between, where we have product market fit, we have go-to-market strategy, we have some clients, we are post-revenues, now we are ready for scaling. So how do you evaluate the companies that are like ours? And because we don't fit the later stage criteria to justify the fancy financial models, and we are over an early stage because we have active products and clients.
It's a tough question. I think I mean, you're gonna hate me, but it depends, right? Because I think the beauty of what we do is that every company is different and you can't just apply the same frameworks, over and over and over. I mean, you can try, but it's generally difficult. And so, I can't, not having seen your companies in action, I can't say, oh yeah, this is exactly how we evaluate. So, I don't know. If you have a more detailed question, I'm happy to answer it, but otherwise it's difficult to answer that question. I'm sorry.
Yeah, I know that some of our speakers have to run. Would you take one more question or not?
I think there's
Will
two
you?
here. Oh,
Yes,
do-
but we
we'll do
had
two.
another
We'll do
one.
two. We'll do two.
Two,
There's
okay.
one there.
Hi, thank you for taking the question. I think my question is aimed toward Pooja. I'm a student visa as well. I'm interested in founding this ClimateTech space. But for student, it's not conventional to not pursue 9 to 5 and go into founder, let alone ClimateTech. When or what you made decision to really go into this path? Was it hard? As much as you can share.
Absolutely, my journey was very adventurous, and you're right, I was on student visa, and I was an instructor/professor at the university. I had a very secured H-1B visa, which is only attached to institutions you can work. But if you believe you are doing something right, and your partners, investors, co-founders support you, they can make things happen, and even the industry supports you. So we thought that what the patent we wrote were going to change and will be a unique idea and will help the United States government. This was pitched to multiple investors and industry people, and believe me, I had to make 10 to 15 sponsor letters of industry experts from regulators to Nobel laureates to get a fast EB1 track visa. But if you believe in what you do, you will get the help you need, but you have to be confident about what you do.
Talk to me.
Yeah, sure, talk to me.
And so we're at Climate Week. We want to change our relationship to the Earth. I think Germany is the only country that actually gives companies lower rates of interest if they're reducing carbon. I want you all to imagine a world where all the companies in your space would be able to borrow very inexpensive money because you're solving this worldwide crisis. I'd love each of you to just think about that together and start with the first panelist. What would it look like for you to basically be incentivized financially to reduce carbon as your business plan and get lower rates?
So, interestingly enough, there actually is a mechanism for that, and it was historically available. So carbon financing was not necessarily a reduction in interest rates, but it was an additional incentive that climate tech startups could enjoy at one point in time. And of course, it needed a global collective interest to create a carbon market. That somewhere in the way fell, but it is still coming back after COP26. We see a little bit more momentum in that. But conventionally, the banks don't differentiate, at least when you talk about the bulge bracket banks and the main institutions, you don't really get anything specific. But yes, the theme is still strong, and so it doesn't help in kind of cost of capital, but it definitely sometimes helps in availability of capital that one can leverage on at a later stage. Because you're referring more for debt, right, banks, so at a later stage it is.
I'm imagining the Federal Reserve decides
we will give lower interest rates to companies, not the banks,
Yeah.
that reduce climate change. And banks will be part
That
of
would be awesome if we can get fiat, if we can get fiat money directly into our startups, that would be great. Without it going through Wall Street. No offenses, but nothing against Wall Street, but I'm just saying, directly from the Fed to clean tech startups would have been a nice scenario. Anything to add?
I can imagine if that happens, for us as clean tech startups, we just get more clients, and I think that's the most important one. So it's we live, or a venture lives by creating value for its clients, creating value for its shareholders. So that would just help us getting more clients, and that would speed up the complete process. So I think it would be a good idea, but it's difficult to implement without over-regulating and making it very complex. We're looking at Europe again. Be aware, don't over-regulate it. Yeah.
I would agree with Chris that it's a circular economy, and if you will put an incentive like carbon reduction interest rates, we'll get more clients, we'll get more investors, because and maybe we'll get more capital, and we all will be very successful ventures.
So I think, like, maybe this is a little bit of a technical answer, but there are mechanisms like that in the US already, in large part thanks to the IRA, and maybe this is what Abijit was referring to. You have the 45Q carbon capture tax credit, the 45E hydrogen production credit, the 48C whatever manufacturing bullshit credit. And so they're not interest rate loans, but they are tax credits that, thanks to the IRA, are now transferable. So if you are a startup that is not profitable and therefore cannot benefit from tax credits, you can still kind of earn tax credits through producing sustainable products or whatever, emissions reducing products, and then sell those or transfer those credits to profit-making organizations that would then use it against their tax burden. And so there's a cottage industry of kind of tax credit transfer marketplace startups that have come into existence in the last couple of years. So it exists, and kind of to the point that I was making a little bit earlier of like now startups being more open to government and sort of regulatory driven opportunities. This is one of them, right? If you look at any climate tech startup that's building things, that's producing hydrogen, sustainable steel, cement, fuel, and look at their business model and look at their economic model, the tax credits play a outsized role in the kind of revenues that they anticipate in the future. Now, is that a good thing? Is a different question, right? So it's important to kind of start, someone was asking, like, how do you innovate in industries that are 100 years old? Well, cement, right? Part of it is you give tax benefits or you give financial benefits for folks that are making cement in more sustainable ways. Okay, great. But at some point, the government can't keep throwing billions and billions and billions of dollars into it, and your sustainable cement has to be competitive with, Portland, what's the standard cement? Portland cement, I think it's called. So the answer to your question is it exists. It's a little esoteric, and finding the balance between kind of government forces and the market is very challenging.
Literally my purse is the Fountainhead book. So one of the things I really love about America is the free market that we have here. And I am grateful for the tax incentives of the R&D credits. But ultimately, I want people to invest in us, and I want to have access to funding from government entities because we're a great company, not just because we're a climate company and it's the right thing to do. So I think when you build company with an amazing business model, very scalable product with great economics, then you do have access to that funding.
I think I'm going to just wrap up and wanted to say thank you, and also that this was obviously a general conversation, and what's happening today I think is a lot is being put under the climate umbrella, and really we need to be moving over to a nuanced approach towards specific verticals under the climate umbrella that have more weight towards either decarbonization or mitigation. And I invite you all to speak and have more nuanced conversations with the panelists and others who are in the space, and thank you all very much.